agent, is a co-founder, chief executive officer of the Phillips Group, a healthcare-focused and a technology-driven accounting, tax, and advisory firm based in Orange County, California, and with clients across the United States. Laura began her career as an entry-level staff accountant for a small local accounting firm. She worked for 15 years and quickly rose through the ranks of senior accountant, accounting manager, and then accounting and tax manager, all while specializing almost exclusively in healthcare before finally founding the Phillips Group with her husband, Andrew, who serves as its chief growth officer. Laura works with dentists and physicians to advise in financial matters and accuracy and broad knowledge of tax accounting. The Phillips Group is a new SMCDS business member. So without further ado, may I introduce you, Ms. Laura Phillips, EA.
Thank you. Well, thank you guys for having me, and very nice introduction. Don't know where that came from, but thankful for it. The end of the year. So we're here to hopefully give you guys some tips, maybe provide some clarity. There is a lot of information out there. And so hopefully we can tell you what's true and what's not from what you might be hearing on the internet. And so that's our presentation. So a little bit about me, but she already went over that, so we can skip past it and just dive into the agenda with the first thing that I wanted to talk about, which is pass-through entity elective tax. And I want to bring this out first because it is one of the newest tax programs and a little bit complicated, but incredibly helpful. Before I dive into things, I will say the majority of what we're going to talk about tonight is with the thought process that you are working under an S Corp structure or a partnership structure. Obviously, you can't be an LLC. If for some reason you're a C Corp, some of the stuff may not apply. But this specifically is for S Corps and partnerships. And where it comes from is it comes from a tax law change back in 2017, where there was what was called a SALT cap, which is a little technical, but it was a law change where personal taxpayers used to be allowed to deduct anything they paid to the state, whether it was income tax or property tax, against their federal income, which was huge in California because we pay a lot of tax, pay a lot of income tax, we pay a lot of property tax. 2017, that law changed and they said, sure, you can do that up to $10,000. And people were not happy. So California tried to come up with some workarounds. Some of them were interesting, like saying California was a charity. You can make a donation to it and take a charitable deduction. But about 3 years ago, 2.5 years ago, they passed something that the IRS said, okay, you can do that. And that's this. So people might refer to it as PTE, or pass-through entity elective tax, or also sometimes referred to as AB 150, which is just the bill that it was part of when it passed. One unfortunate thing I will have to say with this particular is it has a very specific deadline that if you want to use the program, you have to make your first payment by June 15th. This year it was the 17th because it was on a weekend. But if your current accountant doesn't have you doing this already and you did not make any payment towards the program by that June 17th deadline, 2024, unfortunately, you cannot use it. But I still wanted to bring it out because it's so important to remember to ask to use it for 2025. It has very specific rules. Like I said, that June 15th deadline is a big one. The first year that you go to use it, you just make $1,000 payment. We call it a placeholder. You're just notifying the state that you want to go towards the program. But what it is at the end of the year, which is where if you have already done it, is that you're going to try and put in as much, let me rephrase that, sorry. The tax is based off of 9.3% of your net income. And I promise this is going to be the most technical thing, which is why I'm trying to tell you at the beginning. But the tax says that if you own a pass-through entity, an S Corp or a partnership, you can elect to pay in 9.3% of your state net income to the state of California through the business, and California will take that tax payment and move it to your personal liability, which is very, very helpful because this business, this pass-through entity, does not have that $10,000 limit. So every dollar that you pay into this program, you get to deduct federally. So you make the tax payment personally, you can only deduct up to $10,000, and that includes your property tax you pay on your home if you do pay property tax. If you pay it through this program, you deduct every dollar. So it's very specific, very much have to follow the rules. There's no grace period on it, but I would highly recommend either making sure that you follow up and get that 9.3% or as close as possible paid in before the year end. You can take the deduction, or make sure in 2025 that you are using this program. There is not a ton of things that are only positive that we get from taxes and the government, but this is really, truly one of them. So very beneficial tax law. It just doesn't happen. So please consider doing the pass-through entity program. So that is my first key point that I wanted to go over with you guys. Yes. Yeah, of course.
You're talking about putting money that's earned through export?
Yeah. So yeah, and I'll just give a quick overview. So if you guys aren't aware, when you guys earn money in your S Corp, you really don't pay tax on the S Corp level. Like you never pay federal tax. All the income comes through on your personal return. And so this tax comes off of that number solely from the business. The 9.3, excuse me, the 9.3 comes solely from the business. It's paid in from the business, but it's moved over to your personal tax liability where you pay the majority of your taxes. Okay, and then it gives you that federal deduction. Most of the time, it's easily saving between $5,000 and even $20,000 on federal taxes just by jumping through some hoops. There's nothing else you have to do. Another thing I want to say is a lot of people do think that this is some additional tax that they have to pay. It doesn't. It isn't. It really is in place of personal income taxes you would be paying. You're not paying anything in duplicate. You're not paying more. It is really working out to your favor. Okay, that's the first program. The second thing has to do with kind of my disclaimer at the beginning, which is don't believe everything you see on the internet. So I get so many of these videos sent to me on a regular basis from clients, and social media is great, and having the ability to talk to fellow dentists about what they're doing is helpful, but you have to be careful, because here is one that I'm going to say do not do, and it's very misleading, which I'll explain why.
You can pay your kids up to $12,000 a year and it's tax-free. The IRS allow any sole proprietor or partnership LLC to actually pay wages to the kid as long as they're doing something inside of your business, and there's no age limit. So you get to write off the $12,000 against your income, and your kids get to keep the full $12,000 without paying anything to Uncle Sam. Now, they were smart.
Okay. So I don't know if any of you guys have seen a video like that, but it's very, very, very misleading. And so we're going to go over it. And I'm going to actually jump right here to the your kids portion because we just saw that, and explain why it's a little misleading. So paying kids is absolutely a tax strategy. I'm very much a proponent that everyone's structure is a little bit different. So I really do recommend that you speak to your tax preparer specifically. But paying your kids may be no income tax, which is what this gentleman was referring to. But as you notice, he said, you will not pay Uncle Sam $1. And that's very, very misleading because you are still paying payroll taxes. So if you pay your kids, you put them on salary, you have to pay Social Security, you have to pay Medicare, and here in California, you have to pay SCI. It works out to be 16% that you're automatically paying in taxes. Now, your tax bracket most likely is higher than that. So it still very much might be a net positive, but we have to keep it in perspective of does it make sense for you in that particular year? The other thing is age. It needs to be age appropriate. If you're 1-year-old, you want to pay them $12,000 how could you really rationalize that? You know, there is child labor laws, there is some things to think about. The real benefit on paying your kids is a Roth IRA. So kids are allowed to put money into, or any taxpayer is allowed to put money into a Roth IRA if their income is below certain limits and they have earnings. So they've been paid a payroll. If you have, let's say, a 15-year-old who you decide to pay, probably a reasonable amount would be around $7,000 to $10,000 for the year, because it's their part-time afternoon job. They come in and help you file, they come sweep, they do whatever they might do. The real benefit is that you can take that amount that you've paid them up to the annual limit of a Roth IRA, which is normally around $7,000. It goes up about $500 every year, and invest that money for them. I have to be honest, they have to take control of it when they're 18. So you have to decide how much you trust your kids. But if they hopefully make the right decision, that $7,000, $8,000 that you put in every year, 50 years in the future, when they go to retire, it has compounded. They get to take that money out and they pay no tax on what you originally put in or the earnings, which is huge. So you've just made them a pretty substantial savings account that's going to sit with them for, like I said, easily 50 years. We start at 15, we're going to wait till 65, and they don't have to pay any tax. So the passing the income down to your child, definitely a positive, but be wary that you will pay payroll taxes. So you want to make sure that your tax bracket is more than the 15% that you have to pay in payroll taxes. And then also know that the real benefit is the investment strategy for your kids. Anything in regards to payroll, this is definitely a year-end situation because you have to make sure it's processed by 12/31. So payroll has very specific dates. If you're considering putting your kid on payroll, you absolutely can. You can do one salary if you say, well, Laura, I didn't start all year long. You know, is it a red flag if all of a sudden I process a check for whatever the amount might be, 5,000, 10,000? That's not a red flag. It's not a big deal. You can process it, but it has to be done by 12/31. On the other side, though, is for yourself and your spouse. So we don't want to forget our own salaries. Probably most of you are doing something on a regular basis. But if you have a retirement plan, please make sure that it's fully funded, that you actually, the deferrals are being put in properly. I see way too often that the doctor has gone ahead and transferred the money into the retirement account every month, every pay period, but payroll didn't pick it up. And so you want to make sure that you look at your pay stub and check and make sure that that appropriate deduction is reflected before December 31st. If it's done after, it can create some significant headaches for a lot of people involved, including your accountant. So please go ahead and check that. The other thing to think about with your payroll is how much it should be. So there's reasonable compensation. You guys have probably heard that word before. And it's that the IRS requires that everyone get paid reasonable compensation. Obviously, as professionals, that's going to have a certain dollar value. You're going to be making more than fast food or you know, someone with no experience. But at the other side, I'm a big proponent that you don't need to overpay yourself either. So there are certain goals like making sure you fully fund the retirement, fully fund your Social Security if that, you know, if that's something that's important to you. But beyond that, you probably actually want to limit your salary. So it could be that by year end, you realize you need to pay yourself a little bit more because you need to get that retirement put in, or it could be before year end, you need to stop paying yourself because you don't want to be overpaid. The average doctor, if you're not using a high level retirement plan, which we'll kind of get into, realistically should probably be paying themselves between $80 and $150 annually. There are a lot of tax savings techniques like that pass-through entity that we just looked at that require for you to have a lower salary. So the pass-through entity you can use up to your net income in your practice. If you go ahead and take a very large salary and zero out the profit in your practice, you can't use pass-through entity anymore because it's 9.3% of your profit. So there has to be something coming through to use the program. So it's a balancing act a little bit, to make sure that these goals all align, that you're getting that reasonable compensation, you're funding for your retirement, but you're also not overstating it, paying too much in payroll taxes and not being able to take advantage of other plans. And then spouse, I get this question a lot. Well, my spouse helps me out in the front. They think that they should be paid $80,000 a year. And realistically, I'm sure they should, but from a tax standpoint, it doesn't really help things. So the majority of the time, if you do have a retirement plan in your office that your spouse is eligible to participate in, you want to make sure that you're paying them enough so that they can take advantage of that. So if it's a 401k and they can put in, $30,500 for the year, you want to run a payroll, maybe about $35,000, just over that amount. More than that is not particularly beneficial unless the Social Security, once again, is important. People have mixed feelings about Social Security. I'll kind of put that aside, but if your spouse isn't participating in either retirement, whether it's an employer-based plan or Social Security, they shouldn't actually be paid through salary at all. And if they do have their own job, it's always better to have the retirement contribution go through their own employer versus yours. So if you offer a 401k and their work offers a 401k, it would be better that they fully participate, generally, that they fully participate in their own plan through their work and get the match from that employer rather than you having to pay it out. Okay. Getting into retirement plans. So we have CalSavers, which we're hopefully all familiar with. It came up a couple years ago, where everyone needs to have a retirement plan if they have 5 or more employees. And starting pretty shortly, what's going to happen is if you have 1 or more employees, you also have to have an employer-based retirement plan. What that's meant for dentistry is retirement plans weren't regularly offered a few years ago. I would say 10, 15 years ago. Maybe there was something in the practice, but most likely not. Now they are. So hiring is hard, as you guys obviously know. Finding hygiene and so forth is incredibly stressful at times. So being competitive and offering a retirement plan can help you tax-wise, and then also have something for your employees. So we're going to go over an overview of the plans that are generally offered. This is a SEP IRA. SEP IRAs are almost exclusively used for associates. So if you happen to be an associate that has your own S Corp with no employees, this is a wonderful plan for you. Or if you've just purchased a practice, this can also be a good plan for you. But the bad stuff is right here where it says employer must contribute if employee worked 3 out of the past 5 years. So on a SEP IRA, which mind you, this is tax strategy because when you put the money into the plan, you go ahead and get the deduction for it, which reduces your income. But on a SEP IRA, the contribution solely comes from the employer. So it's only the corporation putting money into this plan. And so if it's just you as the only employee of the only employee of the corporation, great. It's your money going to you. It's no big deal. It's great because it's low cost. So it's a simple plan. You don't have to pay a lot to administer it. But as soon as your employee hits 3 out of 5 years of working for you, whatever percentage you put in of your own pay, you also have to put in for your employee. And so the max is 25% of the owner's salary. So if you pay yourself $100,000, you put in $25,000 for yourself, you have a front office that's worked for you for a long time, you have to also put in 25% of their pay, and they don't have to put in $1. So it's a very great, but it's kind of the entry level retirement plan is the SEP IRA. Definitely recommend it if you're an associate. The other good thing about a SEP IRA is it actually can be started the following year. So a lot of what we're talking about has to be done by December 31st. This doesn't. So if you go to sit and do your taxes next year, you think you might qualify for this plan. The nice thing is you can go open it and fund it as long as you do it before your corporate return deadline is. So that's March 15th. And if you go on extension, it's September 15th. So you can have some time to decide discretionary whether or not it works for you in that particular year and not be forced doing it by December 31st. Excuse me. The next one is a simple IRA. And this one we see quite a bit. And it's also, you know, the name is simple. And so what's good about it also is it has very low maintenance costs. What's not great about it is how much you can put into it. So it's the max is for this year is $16,000. If you're over 50, you get an extra $3,500. And it goes up about $500 to $1,000 every year. The match is 3%. There is a 2% match option, and I would strongly recommend you don't do that. The difference between the 3% and the 2% has to do with if you take the 2% match, anyone on your staff who's eligible, whether or not they participate in it, you get to put in 2% for them. If you take the 3% match, yes, it's 1% more, but you only put it in for those who put their own money in. So it makes your employees have a little sweat equity into the plan rather than just getting paid out for it. And then that 3% match also works for yourself and possibly your spouse if you have them on the plan as well. One big thing is the plan termination. So this plan is good. Like I said, low fees, doesn't have a ton of rules about it, except for it can only be stopped as of 12/31. So if you decide that you're just not getting enough money into a retirement account annually because you're limited to this $16,000 or $19,500, and you want to change to, for example, a 401k, which we'll discuss next, you can only do that at year end. And technically, you have to give 60 days notice to any employees that you're going to change the plan, which means that basically by Friday, you would have to notify your employees that you're making a change. I will say, slightly off record, most employees would not be sad that you're going to go from a simple IRA to a 401k, which is generally the move that you're making. If you're fully terminating the plan, I would highly advise that you make sure you have the 60 days. But if you're in a situation where you're going from the simple to the 401k, on a 401k, they get a 4% match. On a simple, they get a 3%. Probably people aren't going to be upset if they get 45 days notice versus 60. But regardless, you cannot change the plan mid-year. So this is a great, we have the entry level, which was the SEP IRA for those associates. This is great because it's less liability for the doctors, less in the match, less in the fees for administering the plan, but it's also less in the tax deductions because of how much you can set aside. The 401k, I'm sure you guys are pretty familiar with it. It's definitely the most common. So if you notice here, we just went from 16,000 if you're below 50, an extra 3,500, to 23,000 if you're below 50, and then an extra 7,500. So nearly doubled, but at least about $11,000 more in this particular plan if you're over 50, which is a huge benefit. And then if you have a spouse that can use it as well, now you're talking about $20,000 plus that you're saving pre-tax. The other nice thing about a 401k is there is an option for a Roth. So like we discussed with the kids, on a Roth kind of plan, it's a little different and it might feel weird because when you put money into it, you do not get a tax deduction. But once again, what's great is when you take money out of it, it is not income to you. If you have a particular year where, for example, maybe you're doing a big build out and you know that your income is going to be significantly less in this 1 year, and you already have enough tax savings that you don't need the additional retirement, you can actually flip this for that year and say, hey, I'm going to put my $23,000 in a Roth, which is absolutely wonderful because now you have a little bit, a little bit at least set aside that's growing tax-free. So it's the whole diversifying. Like I mentioned, the match is 4%. And once again, that applies to you. And so it's a little bit more for you, but it's a little bit more for your team. The third thing that's great about this is the profit sharing. So as we mentioned with this SEP, you can decide the following year. With a 401k, the amount that you put in as the employee, which is this amount on the top line, does have to be done by 12/31, as I was mentioning on the payroll. But the amount that you do with the match, which has to do with the profit sharing, that's your corporation making the contribution. And the profit sharing can be figured out the following year. So when someone sits in my office and then I have to tell them, unfortunately, that maybe they owe some taxes because we weren't able to do our tax strategizing throughout the year, this is a great, great option where we go, okay, here's a way where we can get some more money into the plan after 12/31 and hopefully bring that tax bill down. Doesn't work for everyone, has to do often with the age of your employees. If you have employees that are older than you, it can skew towards more of the contribution going to them than you, because it's a flat dollar amount. So we would say, okay, what does it look like if we put 15,000 into the plan? And the person that administers this plan would say, okay, here's an illustration. And they're going to say that 15,000, well, 10's going to go to you, 1's going to go to your spouse, and the other 4 is going to go to the rest of the team. That's a pretty good, because if you break down what your tax savings most likely is from that, you're paying 4 to your team, but maybe you would have spent 8 to the government. And so you might as well build the goodwill in your team and then pay it over to the government. But if they come back and they say, okay, if you put 15 in, 10's going to go for your employees, and maybe 5's just going to go for your family, you might say, okay, unfortunately, just pay the government. It doesn't make sense for this particular year. But it's just an option. It kind of stacks a couple of things. So we have the full contribution here. We have a 4% match for your own salary, and then we have the profit sharing. One thing with the profit sharing, though, is like I mentioned, it has to do with age, it has to do with hours worked, also has to do with payroll. So if you have not set yourself up on a reasonable compensation, and let's say for some reason you're paying yourself $40,000 a year, which I really wouldn't recommend except for in very specific cases, profit sharing probably won't work for you because you've kind of underbid it a little bit. And so that might be something you go, okay, let me look at my profit and loss. Let me sit with my accountant. I'm having a great year. I might want to do profit sharing this year. You need to bump up your payroll before December 31st. So you don't have to choose to fund it. You don't have to choose how much to fund it until you file your return the next year. But anything related to payroll processing has to be done by December 31st. But that's often the reason why some people don't like to move forward with it is it costs a little bit more. It's a little bit more complicated. There's ERISA bonds, your administrator, they're just going to charge a little bit more. It normally runs between $2,000 to $3,000 annually for them to process this for you. There's cheaper options, there are more expensive options. But realistically, if you figure out your tax savings by being able to put another $10,000, $15,000 in the plan, if you're able to use your spouse as well, it's going to probably more than likely completely pay for the fee on the plan. So those are the options. There are a couple other plans that I just wanted to note here. So defined benefit plans or cash balance plans, you might have heard about those. You might have them. They're definitely for larger practices. So they can be a great tool. They also have a lot of social media videos going around about them. The one issue with them is they require a commitment. So when we were talking about the profit sharing or the set buy, when we're talking about larger contributions that the employer is making, you get to opt in and out per year. You get to decide, COVID happens, you don't have a great year, you don't put into it. The next year, if we got a lot of funds, you have some extra cash, you put into it. Defined benefits and cash balance both have, I believe, about a 3 to 5 year commitment to them. So if you go down this road, you do have to put into the plan each and every year, and it can range from about $100,000 to $300,000 a year. So they definitely work, but they're for your high income practices. And then CalSavers is what you can do if you don't want to deal with any of it. So some people just are not interested in a retirement plan. That's fine, but you do need to sign up for the state plan. You cannot get out of it if you have 5 or more employees. Right? I apologize, I'm getting over a cold and it's catching up to me. That's full-time or part-time. And just to let you know, that includes hygienists who might come in 1 day a week once. So just be very clear as we're under the 5 rule. What they say is if you look at a quarter on your payroll tax return, or just look at your payroll for a quarter and you count out the names of people who have worked for you, literally could be worked 1 day that quarter, and it's at 5 or over, you have to participate in CalSavers. So if you're right on the edge and you do not have a retirement plan, I do recommend just going on there and signing up for it. it is a little tedious, but realistically to not be compliant and get the penalties attached to it would not be worth it. And like I believe it's in 2027 that's coming up that they're going to require that if you have one employee. So if you have an S Corp and you're that one employee, you have to have something regardless. So you might as well move forward with something. Okay. Next thing has to do with purchases. So end of the year, it's time to go shopping. Get those big supply orders, buy the iTero that the guy is coming around trying to sell all the time, whatever it might be. So I want to go over these rules. What's really important in regards to depreciation in any sort of way is one, just to kind of clarify, depreciation has to do with what's called an asset, but essentially a piece of equipment. And the rule is any one item that you buy that's over $2,500, the county is going to classify as a piece of equipment. So thankfully, we're living in a day and age that that's probably not going to include the TV in your lobby, probably not going to include your computers. We don't have to worry about any of those. They're just going to be expensed like anything else that you would buy. Probably not going to include a lot of your lobby furniture, but anything dental pretty much is going to hit the $2,500 for any piece of equipment. The other thing to keep in mind is federal and California don't agree on anything. And so there is very separate rules between what the IRS says and what California says. We focus on the IRS because that's where you pay the majority of your taxes, but don't be surprised if they don't line up. Because, for example, on this particular thing that we're discussing is Section 179. And this is what you take on the dental equipment that you purchase for your practice. And on the IRS level, it allows you to write off the whole thing the year you buy it. The cap right now is like $1.2 million. You're not going to be in a situation, I won't say no one ever, but generally you're not going to be in a situation you're going to go above that. You go buy a dental chair, you buy CBCT, you buy whatever you want. The IRS will allow you to deduct the whole thing this year. Whether or not that makes sense, that's a whole other question. So one thing to be very mindful of, and this might sound like a basic thought, but I just want to make sure, when you purchase something, you're not saving the exact dollar of what you purchase in taxes. And so you need to be very mindful of chasing around the taxes to a fault, especially when it comes to purchasing equipment. Because what I see what I see happen too often is someone goes ahead every year, they buy that big piece of equipment, they buy it on loan, they go take the deduction. The next year they do the same thing. The next year they do the same thing. 4 years in, they're carrying loans on all this equipment and they've used up all the tax deduction. And that can be incredibly bad for your cash flow because you're paying a bunch of debt and you're not getting any tax benefit. So where we really like to see it is in this middle section where it's a timing. So let's say, once again, you have a particularly good year, great time to invest in some equipment. You need to, the tax brackets currently are 22, 24, and then they go to 32, 35, 37. So you're sitting right in that 32, and we want to get you down to the 24. This could be a great option. This other thing, which is QBI, is another tax program, and it's tedious. I do not want you guys to fall asleep, but it has an income cap for dentists. And so if it's a position where you would qualify for this very beneficial deduction or not, this could be something that puts you over under that threshold. On California, like I mentioned, IRS says about $1.1 million you can write off the whole thing that year. California says $25,000. So completely different rule. And that can get you in trouble where you say, okay, well, I invested all my money back in equipment, I'm good. And you need to be aware that you're probably still going to owe some California tax just because of the nature. Now, the $25,000 isn't all you get, it's timing. So much of taxes has to do with timing. You're not losing out from California. They're not saying that's all you can do. Just that California says year one, $25,000. The rest of the years, which is normally 5, you get the rest of whatever you paid. So instead of it being upfront, it's more balanced, which can be good, especially if you finance something to take the deduction in terms of I'm writing a check to whatever supplier or whatever financing every single month, and my deduction is somewhat lining up to it, can help. It's not bad. So it's just making sure that you understand that, one, it absolutely can be a good tax strategy but only should be used in those high income years. And it's going to help you out federal, but not state as much in year one. Okay. The next thing is cars. So cars have changed quite a bit over the past couple of years. I can't even tell you how many dentists bought Tesla X's 4 years ago when they were able to write off the whole thing right away. That was the #1 car. It's a little different now, and it's getting a little worse every year. I will say this is a blanket rule. Obviously, we all know we have an election in a week. And realistically, the tax law that we have right now is set to expire at the end of 2025. So everything I'm telling you is for this year, somewhat into next year, but then we can have a whole new law, or they can make it permanent, or whatever they might do. We get changes all the time now. So it's just a little bit of a different world. But right here in 2024, what's different is a car over 6,000 pounds. So we've all heard it before. You buy a big car, you write it all off. Once again, it's a timing issue. Here in 2024, if you buy a car, under 6,000 pounds, let me start there. So just your normal car, you get the full deduction. You're not missing out on anything. It's just over 5 years. If you buy a car over 6,000 pounds, you want that truck, you want that SUV, 60% of what you buy is going to be deductible in 2024, and the other 40 over 4 more years. And then next year it switches. It goes down to 40% upfront, 60 over the next 4 years. And then if the law does continue in 2026, it's going to be 20 upfront, 80 over the next 4 years. So one thing that's really, really key that I always try and tell my clients is, like I said, it's not dollar for dollar. So overspending on a car that doesn't suit your family, I would never, ever recommend. You're going to be able to fully deduct as an S Corp the cost of the vehicle, regardless of the amount or the size. It's, once again, timing. So if we need to strategize, once again, you've had a great year. We need to get rid of some of this income. We funded the retirement. We paid the kids. And you tell me that the minivan's broken. Then I say, okay, let's go car shopping. Maybe it's going to be worth it. But realistically, maybe you're single, whatever it might be, you just don't want the big car. Don't get the big car, please. It's just not worth it. The other thing has to do with electric vehicle tax credits. That has changed a lot this past year. But to be very clear, there's an income cap on it, which is very, very important to know. So if you're single and you make more than $150,000, you do not qualify for the federal electric vehicle tax credit, which is about $7,500. And if you're married and you make over $300,000, you do not qualify. So once again, with kind of the videos, there's videos floating everywhere. Those car dealership guys, they want to sell you a car. And so they're going to tell you everything they want. But you want to make sure that your income does allow you to do it. And then also check the VIN, because there's rules about where the battery was manufactured. There's very, very specific things. One thing I will say about the income, though, the one saving grace is you can actually use it on your income this year or next year. And let me qualify that. So the income limit that I mentioned, 150 or 300,000. Let's say this year in 2024, you're over that income. But last year in 2023, you were under for some reason, just a slower year, or you had paid for something else that gave you a deduction, whatever it might be. You can get the electric vehicle tax credit if your income was lower the prior year. So it's something to keep in mind. There is a possibility for you to get it. So any questions or anything? I'm fine with questions. Yes.
One thing you mentioned,
Yeah.
Out for hardship, you won't get penalized for the withdrawal.
Mm-hmm.
Does that rule apply to the simple IRA or the SEP IRA as well?
Yeah, most retirement plans have some sort of hardship rule built in, but the hardship rules are very, very specific. So make sure that you're following it exactly if you ever have to take money out. Okay. Okay, so moving on to our next thing, which is prepaying expenses or holding deposits. This is definitely a thing I feel like practices who have been established for a long time do. And realistically, if you're on that route where you say, okay, come December 15th, we stop depositing insurance checks, you do want to keep going that route. So, the ball is rolled and you do want to continue. unless you have an unusual year. So once again, that year where you do the build out, or for example, when COVID happened, you just go deposit everything you have because you know that you're a low income tax rate that particular year. But where this can be helpful is surprises. So, you don't have the retirement plan set up in time. There's absolutely no equipment that you want to do, but someone came in and just gave you $50,000 for an implant case. And so you're trying to figure out what to do with it. This is a great strategy because it's quick. It doesn't require too much thought. So it's either holding deposits. We do strongly recommend only from insurances. And I do know that a lot of insurances are paying you electronically now. So it may not work, but if there's a possibility, that's something to do. You would also not want to post them, to be clear. Do not post them in Dentrix and do not deposit them. Lock them in a drawer and do not look at them till the new year. And then prepaying expenses. So oftentimes you could pay a month, 2 months of rent in advance, pay your dental supplier, pay your lab, whatever it might be. These are quick fixes to get us out of, we didn't plan in time and we have some extra income. So when you go from here, hopefully you'll have a chance to look at your own finances. If you see that this has been a great year for you and you're not quite ready for it, we do definitely recommend this. And then, like I said, if this is your strategy every year, please continue it. What can happen if you stop all of a sudden is you just bank some extra income where maybe you are going to jump that tax bracket. You close for the Christmas holiday. Maybe this year it's kind of strange. It's about 2 weeks or a week and a half. You never make those deposits, but this year you decide to go ahead and do that. If you weren't planning on having that extra income, it can throw things. So you want to continue for sure. But realistically, if you're not doing it and you don't have an unusual year, I'm not a fan of it because it does just push it to next year. It's not really strategizing anything. This is what I call the Band-Aid. So it has a point, but it's very much just a Band-Aid. And then this is maybe a little bit of an unusual one. It will mostly, well, just not mostly, it works for crypto. So I don't know how much of you guys may or may not have cryptocurrency, but this is what we call the wild west of taxation because the oversight on it is a little unusual right now. So as I hope you're aware, you absolutely need to report any income that you've made from sales of crypto. But what's unusual about it is the losses. So if you invest at all in stocks and you go and you sell a stock, maybe it became worthless, you go ahead and you sell it. Well, not worthless, excuse me. It's down in value, excuse me. You sell a stock, it's down in value. You go ahead and you try and rebuy that stock within 30 days. That loss that you gained from selling, you can't use. The IRS views it as you never sold it because you rebought it within 30 days. Crypto is different. So the current rule, and we do expect the IRS to correct this because it's a little bit of an oversight. The current rule is you sell crypto for a loss, you go ahead and rebuy it even that day, you get to bank that loss. Doesn't always make sense, but let's say, for example, you're selling your practice this year, which is what we'll talk about on the next slide. So you have a large sale. It's what we call an asset sale. You're going to pay capital gains from it. This is an excellent strategy to go ahead and review crypto if you have it, sell those losses, rebuy them, and you can use it against the capital gains that you might have in that particular year. So like I said, very specific, definitely only works for crypto, but if you have crypto that's down, this is a huge strategy to bank it. Those capital losses also, just, currently you cannot use them back. So if you say I have losses this year, last year I had gains, you cannot roll it backwards, but it does roll forward. And currently it rolls forward indefinitely. So if this is something that you can strategize and just record and have it reported on your return, it will keep moving forward for you for that time where you go ahead and you have that asset sale. The other thing has to do with Roth conversion. This is a big, big benefit for most likely the year after you sell your practice. You can use it while still having a practice, especially once again on a big build out year where you've brought your income nearly to zero. But what it is it's taking money out of those pre-tax retirement accounts. So you have money in a retirement account that you got a deduction when you put the money in. You can go ahead and you take that money out and you roll it over into a Roth. Has to be done in 60 days. Don't go spend the money, but you go ahead and you roll it over to a Roth. From that point forward, it's now growing in that tax-free retirement account. You do have to pay tax when you pull it out. So if there's certain rules, you shouldn't be paying a penalty on it, but you will pay tax. But if you know that this particular year, this is going to be your only income source, is this transaction, it's a great benefit. I was helping someone with this last week. He's moving $150,000 over and he's paying $10,000 in taxes. He's a younger doctor. He recently moved, so he's not currently practicing. And so now it's going to sit there for probably 20 to 30 years. $150,000 will get to be something with only paying that initial $10,000 in taxes. So it's a very, very strong benefit. The reason why I mentioned that it's realistically best used the year after you sell your practice is at that point, most likely you're living off of your proceeds in your practice. Hopefully, if you guys want to, you're not practicing until you're 73, where you're forced to take certain retirement. You're retiring before then. And so that year, the year you sell, you're going to have large income. You're going to pay tax. I mean, there's some things out there, but just prepare yourself. But the following year, you have the money in the bank from the sale, and then you go ahead and you do this conversion and you capture a very low income tax rate for it. I do strongly recommend, so if you think this might apply for you this year, there's still time. It has to be done by December 31st. But I do always recommend you do it at year end. So even if we were having this meeting in January, I would never say to do this in January because you just don't know what's going to happen in the year. And once you do this rollover conversion, you can't undo it. And so if you go ahead and you pull, for example, that 150 first quarter of the year and you win the lottery, you'll be happy. But all of a sudden you have a lot of income and it kind of devalued this. So just make sure that it's something that's very much done at year end. And if it's something that you think could apply for you this year, I really do recommend that you do it. And then moving along here. So this is the sale of assets. So I can't overstate how much tax is timing. You really can choose big life events, hopefully, in certain time of year to strategize things. So for example, if you go to sell your practice, selling at the beginning of the year is much better than selling at the end of the year. And that's just as simple as when you sell at the end of the year, you've worked all year. So you've made your earnings, and then on top of that, you're capturing a very large income for yourself. If you sell in January, you're not. You may work a little bit. Some people work for 6 months, a couple days a week, close out cases, whatever it might be, but it's not the same level. So one is just strategizing the timing. Two is those lower income years. So we were talking about crypto, but let's say you have some stock that's doing really well and you really, really want to cash it out. Once again, if you know you're having a low income year, don't think that you shouldn't tax plan. Use that kind of as almost a get out of jail free card to sit down and go, what can I do to take full advantage of my low income year? What can I sell? What can I capture? What can I convert and get that 10, 12% where normally I'm at 32, whatever it might be. The tax loss harvesting is what I mentioned on the crypto page. So like I said, if you have just done a lot of tax loss harvesting, which is selling those cryptos and banking the loss, even though you might rebuy it, that would now be a good time to sell an asset if you have corresponding. But then, of course, I am not a financial planner. I'm not telling you to liquidate all your assets. So, please make sure that it makes sense. Yes. Yes. Yeah, so capital gains rates are, okay, so when you sell your practice, the majority of it is going to be goodwill, and you pay the most likely long-term capital gains rates on those. Those are a completely different rate than your regular taxes. However, they correspond with each other. And so they stack. And so your capital gains rate is affected by how much regular income you've made. And so the lower your regular income is, the possibility of the lower your capital gains rate is. Okay, so that's the timing of, sell at the beginning if you have the option. Finding the right buyer, getting the right price, these are very important. But if you say, hey, I can close on December 15th or January 15th, as a seller, I'm gonna say January 15th. Okay, that's the timing there. And then this is our last tip, which it might not feel like a tip, but it's very, very important, which has to do with cash flow. So before the end of the year, I get a lot of people say, I need to clear out my bank account, or I shouldn't touch my bank account, or whatever it might be. So I want to clarify something in regards to cash in your account as an S corporation, because I feel like there's a lot of confusion with this. Once again, I'm specifying as an S corporation or a partnership. If you are a C corporation, this slide is very different for you. So please, please keep that in mind. But essentially on an S corporation, when you made the money, when you saw the patient and someone paid you, you're going to get taxed on it. That's the moment that the IRS captures as income, is you receiving income. The fact that that income could sit in your corporate account or sit in your personal account, that transaction exactly does not matter to the IRS. That's not the taxable equation. And so as we get to year end, it's very good to review your accounts. And if you're holding surplus cash, which I do find that a lot are, COVID was scary. People like to have peace of mind there's money in the bank. The general rule is about 150% of your monthly overhead is what you should keep in the bank at any time. So how much it costs you to pay your staff, your rent, your supplies, your labs, your insurances, that should be kept in the bank at any given time. More than that generally is not needed. And personal high yield savings accounts have very good interest rates right now. So if you're worried about liquidity and you want to make sure that you still have access to the funds, don't go spend it to spend it, I highly recommend transferring some money out and putting it in a high yield savings account. Now, this doesn't necessarily need to be done by December 31st, because like I mentioned, it has no tax effect at all. It does not hurt you. It does not help you. But year end is a good time to do a checklist of what's going on and where can I make my money work for me. And that savings account that's giving you 4.5% is probably much more than you're getting in your corporate money market. The other thing to keep in mind, just because I know that there's a lot of misunderstanding, FDIC limit is $250 per bank per individual. So if you're married, it's $500,000 if it's a joint account. But if you have a corporate account at a bank and you have multiple bank accounts, it's still $250 total. It's not per account, it's per bank. So you want to make sure, hopefully there's not an issue. Yes, the government most likely would come through with some sort of bailout, but why take the risk? We can transfer money in 2 minutes on some sort of online account and get you much better interest. So just something to consider before year end. You do not need to zero out your bank account. That doesn't help you tax wise, and keeping the money in doesn't help you tax wise. You want to strategize your cash from an investment perspective. So that was your 8 points. So thank you guys for listening to all of that this evening. But any other questions or anything that I can help anyone with, or thoughts or anything? Yes, thank you. Mm-hmm.
Have you ever heard any updates regarding that?
No, so that's going to very much depend on the election. So the SALT cap, and that's why I started with it, is a very key point. Like I said, if you're not using it, please make sure you use it next year. It's set to expire at the end of 2025, just like all of the other tax laws. But I'm very certain that now that California has figured out the workaround, that if the cap is changed or moved, they're going to continue to use it. It doesn't hurt, other than maybe from a administrative standpoint, it doesn't hurt California at all to offer this plan, right? It's not costing California tax dollars to do it. What it's hurting is the IRS. And so realistically, California would be extremely motivated to keep it going. And California is not the only state that has it. Lots and lots of, especially high income tax states, have now offered a program like this. So I am, as long as there is a cap, I am quite certain that there will be some sort of workaround at this point. Okay. Any other questions?
Is
Yes.
your tax group like tax advisory, a financial advisor, is it an accountant?
Yeah, so we do tax and accounting. So yeah, just a little history. So like I said, worked in accounting for over 20 years. I've worked with dentistry specifically for just under 20 years. And we are a firm of about 12. And yeah, we do full service accounting or just tax. But where we're a little different is this. I'm all about education. I want to make sure that everyone knows why they're making a decision. And I hate telling people they owe taxes, especially last minute. It's not as painful for me as the person having to hear it, but it's still the worst part of my job. So anything I can do to try and get people on the phone to talk to me and help make these decisions, that's what we're trying to do. And that's why I flew out today. Kind of, it's important to me, honestly. It's a little nerdy, but it is. So in theory, hopefully just trying to give you some ideas to make some changes. Because come April, short of those two retirements, the SEP and the profit sharing, there's nothing you can do. If you owe tax from the previous year, you owe tax from the previous year. So proactive is the best advice I can give any of you guys in regards to these strategies. Make sure that you're looking at before that 12/31 day. Okay. Yes. Maybe should we talk after? Okay.
So if you're close to retirement,
Okay.
I've heard not necessary using their home and
I mean, that's, I think, what unfortunately a lot of retired people have to do is if they need to, they use their home in order to do it. Yeah. That would be outside my purview by all means. So yeah, I'm happy to try and find out any information I can for you, but I definitely don't have that percentage. There is one more thing I just want to say that is actually very much a 12/31 deadline, just for one quick more minute, which is the Beneficial Ownership Information Act, the BOI. If you have a corporation or an LLC, you're most likely getting a ton of spam about it, but please know that it's real. It has to be filed by December 31st for every single corporation in America. So whether you very much can do it yourself, to be honest, it's not particularly hard, but I strongly urge that everyone go online. I can give you that website. It's FINCEN. It's FinCEN. But please go online and file that. The penalty for it is $500 a day if it's not filed by January 1st, 2025. So that is not a scam, has to be done. We'll be doing it every year. Okay. Not for sole proprietors and not for partnerships. If your entity is registered with the Secretary of State, you have to file it. If your entity is not registered with the Secretary of State, you do not have to file it. Okay. All right. Yeah. Yeah. FINC like cat, EN as Nancy. FinCEN. So please take care of that. Okay. Well, thank you guys very much for having me. And let me know if you have any questions afterwards. Thank you.